Okay, perfect. So, welcome everybody to our Ask Me Anything session. And we have Ekta Bangur here, and she'll be answering any questions regarding tax. Before we get started, though, I'd like to read out a quick land acknowledgement. So, I'd like to begin by acknowledging that we're meeting from many ancestral territories. I acknowledge that I'm an uninvited guest calling in from the traditional and unceded lands of the Coast Salish nations of Musqueam, Tsleil-Waututh, and Squamish. I thank the First Nations communities past, present, and future for their stewardship, care, and leadership on these lands that we meet on. I give thanks to the ancestors, leaders, and matriarchs for looking after the rich resources and cultural teachings of this beautiful land. Let those of us who are uninvited guests commit to being better guests than those who came before us and go forward in respect and reconciliation. Right. There's not much more from me, so I'll pass this on to Ekta, and she's going to start us off with a quick, brief presentation, who she is, what her business is, brief overview, and then we'll get into the question portion.
Hi, everyone. Good evening. I know I have probably a busy day and a long day, and a topic like tax may not be as interesting, but I promise I'll try and make it as interesting as possible. I would like to first start off with thanking Ness. I know she's not here today, and as well as Suhana and the entire team who's organized this. I hope I'm able to get some, benefit or value to you all attending today. So not wasting any further time, let's get started. Just want to give a little bit brief introduction about my firm, UPSI, Universal Professional Services Inc. A little about us. The firm it's been founded in 2014. It's been over a decade now. We're located in Coquitlam, BC. And the mission was to provide boutique firm to provide tailored solutions. The reason why I say that is because, the tax, there is very interesting, um, it's not a common thing that, even with tax, it can be, situations from a person to person may be different. And that's why we like to understand what is going on and how to cater depending on their needs. So that's why we built a firm on that basis to provide a personal touch to tax. I mean, I know the softwares and everything is available, but sometimes you need those answers. You need to know what you're doing or what you're thinking is right. So that's what we had that mission when we built the firm. A little bit about myself. I have experience over 24 years in the cross-border area, US and Canada, especially. My career, I started my journey with Ernst& Young. I was with Ernst& Young for about 14 years. I worked across various locations in New York, Boston, Toronto, and in India as well. That's where I started my career with Ernst& Young. I did do many other ventures with, mid-sized firms as well as many other CPA firms. Even now, there are smaller CPA firms who cannot have a full-time Canadian, a full-time US cross-border person, but we become like a satellite office to them and help these smaller firms as well with their cross-border needs. Um, my specialization around the cross-border area has been with reporting. Whenever there is cross-border, there is a lot of foreign and international tax reporting that comes under questions. That has been my specialty, as well as tax treaty analysis, especially between US, Canada, and many countries. They have treaty to avoid the double taxation. There might be tax residency issues. Of late, I see a lot of people, they were in one country and now they've moved to the other country. There sometimes might be a conflicting situation of which country residency has to be chosen. So that's something I do assist as well. And then there is a whole slew of this, stock options and double taxation around that area. And I also deal with a lot of audit assistance with CRA, IRS, and other state agencies. Some fun facts about me. I thought just to just to know you all, me personally as well. So I have two kids, and as a family, we love to travel. We love to hike. That's Catabalti, 22 kilometers. I survived. And we also love to do some marathons, adventure. Now diving into the cross-border situations, I'm not sure how many of you here may be in a cross-border situation, so I'm just going to do a very brief and try to cover Canadian as well as I go through this process. So generally, the need of cross-border arises when, either you've left a country or you moved into another country. That is one of the first main reasons. Then the second reason might be if there is employment income, RSU income. So employment income especially after COVID, the global economy and globalization has taken place, a big, big jump over there. So I deal with so many people out here who, sorry about that. I deal with so many people out there who actually live in Canada and are employed with US companies, but they never go to the US to work. They are working out of Canada. So when you're in this situation where you're living in one country but earning an employment income from another country, then definitely there is a cross-border situation. There is stock RSUs are in relation to stock options where it's granted and it vests over 4 years. And in that situation, if you've moved from one country to the other, then that's going to, tail around with regards to the cross-country filing. Pension income, that's a very interesting one that, if you have lived in one country, worked and contributed in Canada for towards RRSP or in the US towards 401k. If you've left the country and you are trying to repatriate back your pension income, it will actually be taxed in the country where you earned it first, and then also the reporting in the other country is going to come in. So if ever you're in Canada now, and let's say you move back to your home country and you withdraw your RRSP at that point of time, your pension income, it will first be taxed in Canada, and then it will be, depending on your country reporting rules, you will have to report that as well there. Citizenship, well, there are only two countries in the world. One is US, the other one I don't even know actually. They tax you based on your citizenship. So US citizenship, for example, if you're a US citizen or a green card holder, irrespective of where you live on earth, you have to file your tax returns. Canada does not have that. Canada is not based on just citizenship. It is also based on tax residency and residential ties. So let's say if you're a Canadian citizen and you decide to move back to another country or your home country, Canada would not tax you just because of your Canadian citizenship. You could continue to hold your Canadian citizenship and yet, break your ties, tax residency ties in Canada. Um, Self-employment income, again, I mean, similar to employment income, if you're living in Canada and you're earning income from other countries, then there might be a filing or a reporting requirement in the other country. Business income, same thing. I mean, if you're running a business, I'll give you an example of Canada and US. So sorry about this. So Canada and US, let's say if you're in Canada and you are selling through Amazon US, or you're selling through, or you're providing services where you're sitting in Canada and you're performing the services in Canada. However, you're generating revenue out of the US. Depending on how much revenue you're earning, there might be actually a filing requirement in the US, even though you may not have to pay taxes. But because you've generated revenue on a regular basis, like there is a US trade or business involved, then there might be filing requirements. Real estate is if you have a property in another country and you're living in other country, generally where the property is situated, that country has the first right of taxes. Then, depending on your tax residency, the rental income might be taxed again. So, but there are treaties to avoid the double taxation. Some of the cross-border differences, I'm focused on the US and Canada for now. Canada is residential ties, depending on, it's just not based on the number of days. US, on the other hand, is straightforward based on the number of days. If you live in the country for more than 183 days, then you are considered a US resident. However, it also depends on the kind of visa you're in, the visa status, as well as there is a treaty tiebreaker as well to, depending to decide which country resident you are. In Canada, there is no concept of joint returns. You and your spouse generally have to file two separate returns. However, it's always, preferred that you file it together so that if there is any credits that is remaining, it can flow to your spouse. In the US, there is the concept of filing joint returns if you are residents and so forth. There are rules around that. But yeah, they could file just the husband and wife can file one return together. Uh, the income sourcing rules are different for each country. The deductions, Canada has RRSP deduction, which is a very common one. There is the home office deductions if you're working from home, and there are certain rules. If you meet those rules, then you are able to claim certain expenses if you're working from home, as well as there is FHSA that has come out recently, the first time home buyer savings account. That is, there are certain conditions to be able to contribute and take that advantage as a deduction. In the US, 401k is similar to RRSP, and state taxes may be deductible. It depends. There's standard and there's itemized and so forth deductions that can be claimed. There is foreign filings for Canada, T1135. If you have more than 100,000 outside of Canada, you may have some reporting requirements. And T1134 is if you own, um, if as a Canadian taxpayer, you own corporation outside of Canada, then more than 10%, then there might be filing requirements. In the US, the most common one is the foreign bank account reporting, FBAR. The thresholds for that is pretty low. So if you have foreign non-US bank accounts of more than $10,000 USD aggregate value, then you have to file these FBAR forms. These actually are not governed by IRS. They're actually governed by another department in the US, and they have criminal penalties if you don't file it. So the threshold is almost about the penalty is almost about $10,000 each bank account not reported. So it's pretty brutal when it comes to FBAR and foreign filings in the US. The TFSA account in Canada, the equivalent account would be Roth IRA accounts. So TFSA is good when you have investments that you want to shelter and not have to pay tax on the growth. Then TFSA is a good account that you could use to shelter your, save your investment growth, not having to pay taxes on that. However, there are limitations in terms of how much you can contribute every year. There is a contribution room to the extent you can contribute. Good thing is the TFSA account can be withdrawn if ever needed. So I would highly encourage you all to use the TFSA accounts if you've not already done that for your investment purposes. Similar to TFSA is Roth IRA in the US. Then there are departure tax implications in both the countries, uh, different rules, but similar concept. I hope I'm not speeding and my pace is okay. I'm not, is it okay? Okay, so Hannah's smiling and giving me a thumbs up, so I guess it's good. Um, Foreign forms, I don't know if I should spend a lot of time here because if it's not going to be applicable, or maybe I spend a little bit more time on the Canadian one. On the T1135 form for Canada, it's exempt for first year of filing in Canada because the Canadian government understands that if you're in process of, moving countries, then there might be some, foreign assets that you're still trying to wrap up. So the first year exemption is available in Canada. The rules around the T1135 reporting is foreign property, which is greater than 100,000. What is included in foreign property is important because many times the clients have come to me and said, oh, they don't own any property, meaning real estate property. Well, the definition of foreign property is beyond just real property. It includes bank, cash, shares, real estate, cryptocurrency, etc. So, if you have a Canadian investment account and you own not RRSP, well, in any non-registered investment account and you hold US stocks, for example, of greater than 100,000, then you might have to get into this reporting and you have to do this every year. There are two methods to do it. Simplified method, if it's less than 250, then it's just a simple declaration. But if it's more than 250,000, there is a detailed method where you need to list each bank account or each, kind of property that you own and list the values in there. The penalties for the T1135 non-filing is about 2,500 every year. And it can be more if it was intentionally not filed. Um, with the US, as I mentioned, the penalty is about $10,000 each bank account not reported. And it goes through criminal penalties, so you can't even abate those penalties. If you've not filed your T1135 and you had to, then there is volunteer disclosure programs that are available through the CRA that can be used to catch up any missed filings on the foreign side. Audits, IRIS, generally the concept is, no news is good news from IRIS. So generally, IRIS does not send out a lot of letters. It does not even give a notice of assessment the way CRA does. But Canada is very, very, very active in terms of the audits of late, especially after COVID. I've seen that there's just much more audits going on. The common areas of audit are childcare, home office expense, tuition fees, donations, medical expense, at least those that I have seen. And then there are complex audits such as foreign taxes, if moving expenses, RSU, double taxation. If these areas are involved, then most likely it's going to be a guaranteed audit from CRA. Generally, the CRA audit process, I mean, I'm just listed here. I know the reason why I brought this up is many a times I've come across clients who've told me that the previous accountant just did not answer when there was an audit. Our firm wants to make sure that, we are with you till that audit is resolved. So we are just not here as a tax preparation. We like to see the end point to until it's complete and assessed. This is our contact information in case you ever want to contact us. We do have a complimentary meeting available for 15 minutes or 10 minutes through our website that you can book, www.upsi.ca. If you ever have any questions, you can book an initial complimentary meeting that we give for our clients to understand the tax situations and see if there's anything that we can extend our help with. I think that's the uh, so far the presentation that I had, and I guess we can get started with the questions.
So if anyone feels like they would like to unmute and ask any questions, they're more than welcome to, or they're able to send them into the chat to myself, and I'm happy to read those out as well. It's up to you guys. And then if not, I guess I could read or can go over what was sent in originally. But yeah, Queen, go ahead, ask your question.
Hello, I have multiple questions. Should I just start with one and then bounce to somebody else, or should I do all of mine at the same time?
You can start, and if someone else has got a question, I'll kind of move through it. But go ahead, start with what you've got, and we'll move on through there.
All right. Hello. Fabulous opportunity, by the way. Really big shout out and appreciation to Entropy for facilitating this. This is fantastic. My question is around GST compliance. So I run a small business,
Mm-hmm.
and I'm a sole proprietorship.
Okay.
And I always say that I'm in it for the passion that I have in providing my programs, but not knowing the business side of things. So all of my questions are pretty like basic when it comes to just trying to understand. And my mom helps me do my taxes, and it's like extra complicated with running a business, and taxes already are complicated. Anyway, so that's just a little background. But my question is, are there any common mistakes business owners makes when they first start charging GST, and how can I avoid them? Because I just reached the threshold like of
Mm-hmm.
making more than 30 grand per year. And so now I need to start charging GST, which was as of last year. And
Okay.
so I started doing that for my business. And my business is a kids musical theater program. So I'm offering services, not products, if that's of relevance. Yeah, so that's just my first initial question is that are there common mistakes that businesses make when they first start charging GST?
I think what you did is right because sorry, I don't know your name. I just shows Queen. So
That's
um,
my name. Queen is my name.
oh, Queen is your name. Okay. Nice name. Um, So, with regards to GST, I mean, the first thing you do need to understand the thresholds because if you are going to earn throughout the year of less than 30,000, then you don't have to collect GST. GST is based on where the customers are located. The kind of services that you're providing looks like BC is going to be where all your customers are based. Then it would be based on the, percentage, which is 5% for services. One thing that I would suggest and recommend you to look into is there is a quick method of GST available. So, for small businesses, it may be hard to collect all the receipts and for the income input tax credit. So basically, you collect the GST, and for whatever expenses that you've made and you've paid GST, you can, offset it and then pay the remainder to GST. That's how it works in a most, common language that I can say. What you can do is for small businesses, the government has the quick method election that is available that you can do that makes it a much more easier and a straightforward process and actually might be better off doing that method where you may be able to save some of the GST out there than having to pay to the government outright back. So that's something I would recommend you to look into and see if that's something that might be beneficial for you.
Hello, also, here's my face. That's funny because my second question for you is what is the quick method for GST?
So for the quick method GST, instead of going through all the receipts and trying to calculate what you've paid for the GST to claim the input tax credits, the government has a set percentage that you can use. I think it's 3.6% for BC. So let's say if you've collected 5%, what you remit to the government is 3.6%. If your expenses, once you've collected your what you've paid is, less than the 1.6% that you're trying, 1.4% that you're trying to save out there. So that might be, that's the easy method of calculation. So rather than having to go collect all the receipts that, you for the payments that you've made and then track those expenses or track those GST, there is a fixed percentage that you can do. So it's a one-time election that you have to make, and you have to make sure that you follow that election throughout. I mean, you have to follow that method throughout. So you can't keep switching between quick method election or, the regular method of GST. So once the election is made, you need to use that, and that might be beneficial.
So what I've been doing right now is just having the total amount of income that I make, which is just based solely off of all the services that I provide, and then
Mhm.
doing that math calculation to be calculating the 5%. So I've been doing it manually, not the quick method. But the quick method would require me to go to each receipt because I was never going to each receipt anyway. So just trying to understand that.
So what you're collecting is 5%.
Mhm.
So the regular method would involve that you collect all the receipts for what you've paid, the expenses that you have done, right? So you've paid some GST as well as part of that process.
Mhm.
So what you've collected and what you've paid, you need to offset that. So that might be a tricky process of trying to calculate, right? For small businesses, there might be like a lot of expenses, a lot of receipts, and really small in value, which may not be worth the whole exercise. So to make it simple, CRA has given this option of quick method election, where what you collected is 5%, and then you calculate the 3.6%. That's what you pay to the government. The 1.4% is what you've saved, and it's with you now.
Right. Okay.
Okay, so it's the remittance rate that's what it's called. You may need to look up go to the CRA website and you'll be able to look into the quick method election and find more details about it.
Yeah, that's fantastic. That's awesome so far. And should I pause here now and let somebody else have a go or?
Yeah,
Sorry,
well,
I'll just add one other thing.
Yeah.
The election is also really easy to make. So you can do that through your own CRA account. I'm sure, have you registered GST already?
Yes.
Yeah, you have registered, right? So then once you log into your CRA account, you should be able to go and see, it should be a very easy way to make that quick method election.
Okay. Thank you.
Yeah.
I think I did see it. I just like 'cause I haven't filed my taxes, but I was just starting to look at it and I did see it, but I was like, I don't know what this means at all. And so I didn't even bother giving it a go. But yeah.
Yeah.
Thank you.
So yeah,
Anyways.
Queen, we'll just move on to Amanda, but keep your hand up and I'll just come right back to you unless Amanda has some more questions. But Amanda, you can go ahead and ask your question.
Awesome. So I'm Queen, you thought you were like asking a basic question. I'm further back than you are. I'm like, I've started a small business. Where do I even start with filing?
Mhm.
Like, because we've done our own personal taxes for so many years, but I don't even, yeah. What do I do? What forms am I looking at? What am I, yeah.
Sure. So let me ask you this question. Now, with regards to the small business, did you actually incorporate the business, or is it a sole proprietorship that you're running through your own um, uh, thing?
It's a sole proprietorship. Yeah.
It's a sole proprietorship. Okay. So when it is a sole proprietorship, generally you have to file a form with your tax return itself. It's called the T2125 form. The form is, if you pull up that form, it's a pretty straightforward, detailed form that has a couple of things that you need to include. Like, you will include the revenue that you have. You will include all the expenses that you have done against the business. There are two other sections that you need that may be important and relevant for you is one, if you are working from home, then you may be able to claim some of the home office expenses for running the business from your home. And there is also motor vehicle expense, meaning if you are using your car, then you may need to see if you're using some of it for business purpose, some of it for personal use, then you may be able to claim the portion that you are using for your business purposes as well. Now, I'm not sure if you've crossed the 30,000 threshold, as I was explaining to Queen, with regards to collection of GST. And if you do think you're going to cross the 30,000, then you have to call CRA, register for the GST, and make sure that whatever revenue you're collecting, you also collect GST as well. Now think of GST as a separate, money that, let's say if you're earning $100 as an example and you're charging GST as $5, I would say that, that $5 is not into your pocket. It's a separate envelope that you're putting that money in. And at the end of the year, that money goes to CRA. So, please make sure that GST, it's going to be a lump sum later on during the year that you have to
Yeah.
pay back. So, remember the separate envelope that is untouchable and you can't use that money. As I said to her, if your revenue is less than 500,000, then quick method election is available for small businesses that might actually be beneficial, something that you need to think about and look through and see if that might be applicable for your business. And where that might be relevant, the quick method election is where you don't have major expenses. It's not a capital intensive where you're buying machinery or, a lot of expenses are, if it's not a lot of expenses, then I think definitely quick method might be a good method that you could use. And yeah.
And then, so at what point should I or do I want to hire, would it be a CPA or a bookkeeper or, yeah.
So if it's not a corporation, then technically you don't need a bookkeeper. As
Okay.
long as you think you can manage your income and expenses, then you don't need to. When it comes to corporations, if you run business, separately through a corporation, then it gets pretty complicated because the corporation is separate, personal returns are separate. The corporation needs to do income statement and balance sheets. And not having the accounting background cannot enable you to build such financial statements. That's where bookkeeping becomes even more relevant. If you are a person and if you can handle Excel, I don't know your business and what kind of transactions you're going through, right? But assuming, if you're well equipped with Excel and if you can manage it through Excel, you don't need an accountant at that point of time. You can maybe book some consultation calls if you don't want to go through the really spend, because with the small businesses, it's not, um, I would say, sometimes you don't want to have those overhead expenses as you're expanding, right? Maybe at a later point of time when you think you're generating enough revenue that you now need someone to be able to help you, that's when you can think about getting an accountant. But if it's something you can, handle it internally, you should be fine.
Awesome. Thank you so much for doing this for us.
No, no worries, Amanda.
Amanda, I also recommend Wave. I'm not sure if you've heard about this. Have you heard about Wave? It's a free well, there's like you can pay like, there's levels, right? So you can pay
Yeah, yeah.
offerings, but I've been using it for like 10 years and it's Wave, and that's where I do my bookkeeping. So it like keeps track of invoices and it has like a beautiful breakdown of like all your profit income and stuff. So just like a Ocean Wave. I recommend
Yes, awesome. Thank you.
checking that one out. Yeah.
Mm.
And then if Amanda, you've
I'm
covered what
good.
you,
Queen, keep going.
yeah, Queen, go for it. Ask your next question.
Okay. My next question.
Mhm.
What type of, for record keeping, what type of records should I be keeping for GST purposes to ensure that I'm fully compliant? I always feel like I am at risk of not knowing what level of what I need to have to make sure that I'm following the quote unquote rules.
Yeah. So for GST purposes, I mean, technical answer is you need to keep all the receipts, okay, for 7 years. That's what the CRA law says. However, I know keeping the receipts may not be as easy as it looks, but I think if you're running a business, you need to have this practice that whatever you buy for business, you should keep the receipts, maybe have a box, just keep dumping them there if you're not very organized year by year. That's what I do. I mean, well, I'm an accountant. I should be doing that. So, uh, so I have this box. I just tack all my receipts and I just, label the year and I leave it up somewhere in there. Um, I've never I've been filing taxes over, 25 years, and I've been doing this for 25 years. Generally, I've not seen a CRA audit for small businesses. I guess they are behind the bigger fishes when it comes to GST, but I don't want to vouch for it as well, when they may change their strategy or how it works, right? So that's my recommendation to you. I think you should have a practice of getting the receipts, whether it's meals and entertainment, or if you're going to Costco, make sure that you have the habit of, that's what I do. I have my personal items and I make sure do a subtotal for the business. And so that way it's easier for me to track because when we go for shopping, we never have this agenda of, okay, this is just my business purpose shopping. It never happens that way, right? Whenever we go out, sometimes it's the personal that's happening. And then the same place, Costco, for example, right? Great place to buy everything. So just the subtotals in Costco is something that I would highly recommend you all to do that. And they're pretty good with, breaking up the totals, subtotals for you for that purpose.
So
So
I have that done that. But I don't have like unless I actually bought something in person and they printed a physical receipt, all of the other ones I have electronically saved, like organized by year. Is that okay, or do I actually need to have them printed, or just if I get audited, I need to print them or something?
I think if it's audited, definitely that's when you need the paper copies.
Right.
As long as you are keeping them in any form. Digital is even better, right? Because I know I've had in the past where I had those receipts and the ink washes away after a few years.
Yeah.
So digital is highly recommended,
Okay.
for sure. Yeah, and that is an acceptable method. But yes, when there is an audit, you will have to print everything and give it to CRA. They're not in the form of digital as yet. Or maybe I have to take that back. I think after COVID, there has been a lot of changes. Fax has been a common method now, even for non-resident returns. Through the CRA submit tax documents or there is an option to submit it digitally as well when there is a CRA audit. But
Okay.
in terms of just keeping it, you could do it either or, should be fine.
Okay. And those are
But
like,
the actual receipts. So if you've spent and you think you're holding on to the credit statement, that's not sufficient. The credit card statements that you get, you also need the receipts along with it.
Mhm. As far as like like what's different between before I was charging for GST and now that I am charging for GST, does that have any impact in um like what type of records that I'm keeping?
It's again boiling down to the input tax credits, right? And in terms of the receipts, in any case, you should be keeping it, right? Irrespective of whether you're charging GST or not, right?
Okay.
But you need to make sure that you're able to draw that line that, okay, you know what, my revenue wasn't crossing 30,000 before I, you know, met the threshold of charging GST. So you want to be in that position to be able to prove it if ever questioned.
And to reaffirm my understanding of the quick method, using that uses the expenses as an offset for the amount of GST I actually have to end up paying. So it's not actually 5%, it's only 3.6%.
6%, correct.
So if I had zero expenses, then it would still be 5%.
5% what you collect and 3.6% what you remit.
Strange. Okay. Why do I get to keep 1.4%?
Because that's what the CRA is giving you as an advantage of running a small business, not having to go through the hassle of the receipts and track everything.
And that's only because I'm doing it through the quick method. If I didn't do it through the quick method, then I would be giving all 5%.
Correct.
Okay, so then I should definitely be doing it through the quick method because I'm not making 500,000, right? That's the number you said?
Yeah.
Okay. I'll definitely do that then. I didn't
Yeah.
do that last year because last year I also had this this thing that I have to now collect GST and give it out. And I didn't do the quick method. So I guess I gave more than I needed to. I remitted all the 5% when I actually only needed to remit 3.6%. So until I'm making 500,000, I should always do the quick method, and then they'll give me a grace being a small business, and I only actually have to give 3.6, right?
Correct. As long as you have to make sure you make that election. You can't just start doing that. You have to make sure that you make that election. So let's say if you make it now in 2025, it's going to be starting 2025 that you can start using quick method election.
Oh, I can't use it for my 2024 taxes?
Yep.
Oh, okay, wait. So right now I have to just select quick method?
You have to make that election through your CRA.
Like making like a quick method account kind of thing.
Quick method, yeah, there is a form that you need to submit it to CRA to let them know that, hey, you know what, this is what the method I'm going to use going forward.
Okay. But for as far as taxes going right now that are due soon, that I have to do regular.
Yeah.
Okay. All right, well that's good to know.
Yeah.
Okay, that's my question for now. Do you want to pause me?
Yeah, we'll move on to best friend. If you have a question, you can go for that, and then we can go back to our bestie queen.
Yeah, that's a very low day to me. I'm having cold, but I have a question regarding the um what's called disability tax credit, and also what amount there is. They say like you have what is the amount of tax credit, and how does it work? Like if you have tax credit, and if you is there any limit when it comes to how much tax? Let's say I am also on tax-free insurance, whatever they call it, like they don't give you T4. So I have to file tax, but I have to report that I don't have, like I didn't earn. That's what they told me. So I just say, I want to say like, how does, like, it's my first time to do it this year, so I'm a bit confused. I would love to have some insights on it.
Okay. So with regards to disability tax credits, definitely there are thresholds. I mean, in terms of the credit that you can get, the amount. But first, you need to get the form T2201 that kind of gives you a certificate, and you need to send that certificate to CRA to be able to get that credit. And then,
Sorry, from who did I get? I get the top form?
so T2201, disability tax credit, I think that's a form that you need to fill it out, and your medical practitioner needs to sign it to be able
No,
to.
I already got approved.
Oh, you got it approved already.
Yeah, so
Okay.
I don't know if the form it was saying a letter of determination, it was saying. And then they gave me some refund or something from the past years. So there was
Okay.
some amount in that, and also they reassessed my tax from the past year. So where do I find like the amount of tax? Like I know, like when last year when I was filing my tax, they asked me an amount of tax.
So generally, I think the credit you can get is up to 9,872 for 2024. I don't know the amounts for prior years, but if you filed a return without that credit and you got that letter now, which may be applicable to previous years, probably that's why they've gone and amended your previous year tax returns to claim that credit back to you.
Mm-hmm. So, like, my question is like, how do I file it like this year? Let's say today, this year I have long-term disability, which is from my insurance, and then because I have paid for that, so I don't pay tax. They told me I don't have any T4 or T5, whatever they say. So it's non-taxable. So I have, but how do I file this and combine with this tax credit, whatever? It's just
Um,
confusing for me. I don't know. I file my tax but all the time, but this is a bit. I was working, so I can just have my T4 and like and put all the
okay.
amounts there. But now I don't have those kind of things. And how do I file it?
Oh, okay. I'm so sorry. With this one, I don't know the answer to this question, but I can research and get back to you at a later point of time if that's okay with you. You can leave your email address with Suhana, and I will research this and get back to you.
Sure. Thank you so much.
No worries. And if you could also, just give a little bit of more background in terms of what exactly did you get from the insurance company? Did the insurance company pay you?
Yeah, yeah, they do pay me.
Okay. So is it through the government that you're receiving some kind of
No, it's
grant or?
from private insurance from work. So,
Oh, okay. 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 So that's something I'll have to look into and get back to you. But I'm really sorry to hear about your situation. I hope you recover soon.
amen. Yeah, thank you. Thank you. Thank you so
Yeah.
much.
Awesome. I'll pass it back to Queen if she's got any more questions for us.
I do. Hello.
Yeah.
My next question is tax planning for growth. As my business expands, are there specific strategies I can implement now to help reduce my tax liability later?
You also have a sole proprietorship, correct? Yes. So in terms of tax planning strategies, I think it's kind of very difficult because generally when you run a business, it's whatever expenses that you do that kind of reduces your income to be able to that's offsetting your income, right? From a personal tax side, I can tell you that there are certain deductions available, such as RRSP. I'm not sure if you're doing that
Yes,
already.
I
You
just,
are.
yeah. Oh, and then I also just did the FHSA, the First Home Savings Account. So
Correct. Yes. So I'm just going to expand a little bit on RRSP for everyone else. I'm not sure if they're still aware of the advantages of RRSP. One, definitely you get a tax break for contributing towards RRSP. Second is if you've not bought a home in Canada and it's your first time home buyers in Canada, then I think starting this year or last year, they've actually, the threshold has been increased. So up to $6,000, $60,000, you can withdraw from your RRSP towards your home buyers. So basically, you're taking a loan out of your RRSP. So it's your own money. You put it into RRSP, you took a tax break, and now you're withdrawing that money towards the down payment of your house. You're taking a loan, which is an interest-free loan, which you need to pay, I think it's 20 years or 15 years, and it starts after 2 years from the withdrawal year, which I think is a great option, for you to take the tax break and take the advantage if you've never bought a home, because at the end of the day, you will need cash for your down payment. The one thing to think about is when you do your RRSP, make sure, if you're planning to buy a home, that it has to be in the account for at least 3 months before you're able to withdraw it towards your home buyer's plan. And the 60,000 is individual. So if you have your spouse and if you're buying the house in both of your names, 60,000 each that you can put in and be able to withdraw um, towards your first time home buyers plan. Now, one other advantage that you can use with the RRSP is, let's say if you have one person who has a higher income and the other person has low income, then you could also do a spousal RRSP, meaning you are contributing to and indicating the spousal to be the beneficiary. You get the tax break in the year you contribute. However, when the spouse withdraws it, at the time of withdrawal, it'll be taxed in the hands of the spouse and not you, which may be an advantageous situation if you are at a high tax slab. And in the future, if your wife does not have a lot of contribution room, and you're just kind of equalizing it so that your tax slabs would be matching in the future at that point of withdrawal situation. But the thing is, apart from the home buyers plan, or there is one other thing, I think towards your learning or towards education that you can withdraw as well. There's certain rules. I'm not quite clear of that, but yeah, these are the only two conditions when you can withdraw your RRSP before your retirement. If you plan to withdraw for any other reason, there might be penalties associated with your withdrawals. So that's something you need to watch out for, is that, when you put your money in RRSP, the government wants you to save for your retirement. So ensure that you don't want that money, before, unless there's an emergency, God forbid, then it's a different scenario. But then, as much as possible, plan for long term when you put in towards your RRSP. It's the same thing with the FHSA is recently, I think it's a combination of TFSA and RRSP that they put together. There is a contribution room every year up to the extent that you can contribute. Make sure you open the account of FHSA, because if you do not open the account, you do not get that contribution room. So if you've not opened an account in 2024, then you've lost that contribution room. You can't get that. So make sure you open the account and you get you have that contribution room. Again, this is a first time, home savings account that the government is encouraging for everyone to save so that they can buy a home. That is the whole objective around there. You get a tax break when you put the money in there. And if it's towards a first time home that you are able to take that money out tax free without having to pay. And any growth in FHSA account is also tax free. These are some of the personal strategies that you can think about. Does that help?
For the first home saving accounts, I just have a question that sparked my mind. If you have two people contributing, like both my mom and I opened an account, and if we plan to buy a house together, because it talks a lot about online about like spouses and partners, but obviously my mom and I are not a spouse partner, right? But can we both be contributing to our own first home savings account and then buy a house together
You
with
should be able to.
and you
Yes,
can only put a certain amount in, and it's only for like it's what, 8,000 for 4 years or something like that,
correct.
which is not
Those,
enough
those,
house, but it gets you started.
sorry, sorry.
Well, I was just saying, which is not enough to buy a house, right? But it
Yeah,
gets you started.
yes, yes. And RRSP, I would definitely tell you to take advantage of that, because earlier the thresholds were 35,000. Now it's bumped up to 60,000, which is a lot. And it's individual. So upright, you have 120,000 that you've contributed, taken a tax break, and then be able to take that money out, your own money out, without having to pay. So you're not waiting until retirement. You've taken that advantage of that. But you have to still pay it back to the government over 20 years or 15 years. I don't recall. Yeah.
And that's per year, are the the registered retirement savings account, that one
Sorry?
per year you can put a certain amount in, or
That's correct. So generally, even for RRSP, there has to be a contribution room, and the contribution room is based off your prior year earned income. It's generally 18% of the prior year's earned income up to a max of 30,000 for 2024, I think. That's the amount of contribution room that you have, and you have to contribute to that extent only. If there is anything, if you over contribute, then there are penalties associated. So I would definitely make sure that whenever the CRA sends the notice of assessment, they also send you the contribution room, what is available for you to contribute towards your RRSP that you can use. Any not used contribution room from previous years gets accumulated that you can use in the future as well.
So that's great because it leads into my next little segue here. I did accidentally over contribute, I realized.
Okay.
And then within 30 days, I realized that. And so I took it back kind of thing. Um, and they took it out and I did whatever with it. I fixed it and put the right amount in that I was allowed to contribute. I was Googling online and it looks like I'll still get a penalty. It's like a percentage of what I had contributed over will be a percentage. Is that true? Is that
It
true?
is true. It is true. It is true. But then, was the contribution over contribution more than $2,000? Because generally there is an exemption of $2,000. So I'm not sure. Like, did you cross that threshold?
I think I did. I think I did significantly. Yeah, because I like messed up and didn't realize that what they had like allotted for last year I had done it. Like there was a whole like it was quite a bit more. Yeah, I think
Okay.
yeah, no, it was like 30,000 more I contributed.
Oh my God. Okay. Then what I would suggest is you do a form called T1 OVP form. Um,
Can you say that again, please?
yeah, sure. It's a T1 OVP. It looks complex, but then I think if you follow through, you should be able to fill that form. So generally what happens is, if CRA has to calculate any interest or penalties for the over contribution, they do not have visibility of what your contribution room was. And if let's say you did it in 2024, January, then starting January, your 2024 contribution room has also added in. Okay, so there might be ways to avoid or reduce the penalties. The T1 OVP form, filling it in to its accuracy, there's a lot of pieces to that. If you fill it correctly and you submit it to CRA, so it's better that you calculate and you give them the interest and penalties rather than they calculate and give it back to you, which might be way off and much higher than what you think it should be. So doing the T1 OVP might be a better idea for you in the and do that.
Even if I even if I took it back, it'll still show in their records that I had at one point over contributed, hey?
Yeah.
Wow. Okay.
And once they have that record, it's not necessary that they'll come back to you immediately. So we had one client where we were dealing with, they came back after 5 years to deal with this overpayment. So it's better you do that and get away with and not have to worry about it in future.
Right. Because it's like a percentage of it. So I think that I'll have to end up paying like $600 as a oopsie. It's a huge
Yeah.
fee. Okay. Thank you. That's good for
No,
now.
yeah, no worries.
If anybody else has got any questions, feel free to raise your hand or unmute yourselves. Send us a message if you like. Now's your time. Ask literally any simple question. I think it's worth it to have someone who's sitting here with abundance of knowledge in tax. If
I
not, and
can
if you still have questions, then you're still more than welcome to.
I can also go over, Sohana, I think you had emailed me those questions, right?
Yeah, for sure. If
I
you want
think
to
I
go
think I
through
can.
some of those.
Yeah, yeah. I think there was a question about cross-border accounting tips relating to having moved from US to Canada and found generally when there is cross-border taxes involved, I would suggest to seek help because if you don't want to get the tax returns done through someone, at least get a consultation because you don't want to be in a mess situation with penalties because the penalties are too high when it comes to cross-border. You may not have to pay taxes, but you may have to do the right disclosures. So that's one suggestion I definitely have for cross-border situations. There's a question about how to start filing my tax form. I'm not sure if you're referring to Canada or US. However, if it is a simple, it's not a very complicated tax situation, then there are softwares, well, simple, TurboTax. so forth that is available that you could use to file your own taxes. I don't know how those softwares work because I've not worked with those softwares, but I know many people in the past who had simple tax situations have used those softwares. When it comes to personal and business tax, personal income tax and business tax, if we're referring to corporations, I would suggest you again when it comes to corporations, because with the whole financial statements involved when there is a separate corporation, there might be bookkeeping services that you may require. And really, you don't have to go spend a lot on it. Like, for example, in our firm, what we do is, depending on what your needs are, we suggest Wave, as Queen had suggested, is one of the softwares. We have some inbuilt Excel templates that you could use, which you do not have to really spend a lot in terms of bookkeeping. It's a simpler form. As your business grows and your needs are increasing, you can switch softwares. So Wave is a free-based software that is available right now as you're growing. Once you think you need to expand, you've got payroll and more complicated things, then QuickBooks is another software which is pretty reasonable, easy to use, and highly popular, very popular software that I would suggest, where you have to generate invoices, you have to run payroll. That's another software that you could use. Um, I think, yeah, where to start small business bookkeeping for tax purposes. As I said, depending on your needs, depending on where you stand on your business, I guess you'll have to make a decision in terms of whether you can handle it internally, or maybe first year or second year to get the understanding, you get a accountant involved. And then once you have a better handle at it, you don't need an accountant at that point of time as well. Um, I think GST we covered quite a bit already. And tax write-offs also we did discuss in terms of some of the options available when it comes to personal taxes. When it comes to corporate, there is another example. There is another it's called the health savings account that could be used. So many a times small businesses, you do not have group benefits like the bigger firms have, and you may not get so just to have something off the bat to be able to cover your medical expenses. There is a HSA, medical expenses to the company, healthcare savings account. So these are the companies that's more like a pay as you go kind of service. So you don't have to pay immediately for the medical. However, whenever you incur a medical expense, you need to go to the HSA savings account, and they'll take 10% additional, but they'll be able to generate those through the corporation. So you can get those medical expenses covered through the corporation itself as a deduction. Um, I think that's about it. That's all I can think of.
Perfect. And Queen, if you did have anything else, now's your time. If you want to ask me more questions, same for anybody else. If you want to send me a message or raise your hand, feel free. But Queen, you can go ahead.
Okay, dokes. I just have a few left.
Sure.
Are there any tax deductions or credits I may be missing out on as a small business owner that could reduce my tax liability?
Uh, I can't think of any. As long as you're taking, if you're running the business from home, just make sure you're able to claim the home office expense. Motor vehicle expense is another one that you can do. Uh, Generally, meals and entertainment is, uh, if you're ordering food at home, which you cannot have 100% towards business. Some of it can be claimed towards business as long as you can justify it. Then with regards to the regular expenses that you run for the business that you can claim, with regards to telephone, internet, so forth, if you're using towards your business, it might be very difficult to say that this is for personal use and this is for business use. So that's why CRA does give you a little bit of liberty there, that telephone, internet, all of those expenses can be 100% claimed towards business. Okay.
Phone and
um
phone and something else?
phone and internet, because you need internet for everything, right? So, but it's CRA understands, you cannot keep a track of this is my personal use for internet, this is my business use. So up to some extent, you can claim 100% of your internet expenses as well.
I find it difficult to like I understand the idea of like claiming for home office. You have to like correct me if I'm wrong here, but you have to like calculate the percent like how big your house is and then how much of your house, like what percentage of your house you're using for your business and then like whatever that is like divided by the rent or whatever. Like there's some sort of calculation there to be able to figure that out on how much exactly expense of the rent based on how much space you have
Correct.
using for your business, right? That kind
Yes, that's correct.
of.
Yes. So the Form T2125 actually has a home office expense. Um, that's what you would have been using, right, to file your self-employed business income and expenses so far.
Perhaps.
Yeah.
My mom has primarily done a lot of it for me in the past, and I'm wanting
Okay.
to take more initiative on understanding. So that sounds right, but I
Mhm.
honestly don't know.
Yeah. So the Form T2125 has a whole section of home office expense. It's pretty detailed. It's going to ask you for all the expenses, ask you what is your square footage of home, what is your square footage that you've used for business, and that's what you need to be reasonable. I mean, if you want to say that, oh, I'm using 50% of my home for business, CRA may come and, you may come and audit that and tell you to explain. And actually, home office expense has become their favorite topic to audit as well. The reason being after COVID, a lot of people have started to work from home, correct? And then taking undue advantage of claiming expenses. So I have dealt with audits where they've actually asked the map of the house and to draw and say, okay, how much is being used for business? And then if it's let's say a one bedroom home, you cannot claim the whole one bedroom for the entire time for business. You're sleeping in that room as well, right? CRA understands. And the people in CRA are people like you and me who are sitting there and who are reviewing. So they know the concept, just like we understand. So you need to be reasonable when you try and claim the home office expenses, as well as motor vehicle expenses as well, right? Like, for example, if you're running a business from home and you're claiming home office expenses, that means you're doing business in your home. So then the question is, what is your travel related to if you're not going out, right? So it may contradict of what you're trying to claim out there. So you need to be reasonable out there.
And for me, I do both. I do things at my home, and then I also go places to offer my services. So I do have a bit of both.
Okay, so as long as it's legit, as long as it can be proved, as long as you're keeping track of it, you should be fine. You should be able to claim the motor vehicle expenses as well.
Can you claim, like, so in my house, I use like my bottom floor, like the basement kind of idea as my home office, because that's what I do.
Mhm.
Can I claim that as 100% of the time I'm using that as a home office? Because it doesn't get used for anything other than that. Not that I'm there 100% of the time, but that it doesn't get used for anything except for that. Do you know what I mean?
Yeah, but then you need to be careful. Like I have a office, built in my home.
Mm.
Then in the past, pre-COVID, I know CRA has actually gone into homes to verify that if you are claiming an office to be used 100% for business purposes, then you should not have, like, you cannot have a, let's say if it's your basement and you're going to put a elliptical machine out there in the basement for your personal use, then on what basis did you claim it for 100%? So you need to be able to justify that, first thing. Second thing is you need to be careful because you're using your personal residence, right, for business purposes. And later on, when you sell, your capital gains are exempt for personal, under the capital gains personal residence exemption. However, if you're saying that majority of your home was used for business purposes, then on what basis are you claiming the personal residence exemption too? So that's something that can be debated as well.
So then you would say that I'm using my basement 50% of the time it's being used as um
Business.
as business. So a
Yeah,
percentage of the house and then a percentage of that house that you're using.
correct.
Wow, so much math. But that
Yeah,
does okay.
yeah. Mhm.
Fabulous. Okay, so then my last question, should I go
Mhm.
Or yeah, okay. Is this one's a little bit more personal to my situation.
Mm-hmm.
So I run a business
Mm-hmm.
where clients can choose to pay via credit card or e-transfer.
Mm-hmm.
Um, okay, wait, I'll just read what I wrote. I run a business where clients pay via credit card, and each payment includes an additional service fee charged by Wix, the online payment portal that
Mm-hmm.
I use. When I send invoices to my clients, I break down the total into tuition, the portion that goes to me, tax, GST, and the service fee, which goes directly to Wix.
Mm-hmm.
My question is that Wix provides me with a receipt showing the gross amount paid, then automatically deducts the service fee before depositing the remaining amount into my bank account. However, because my gross statement includes the service fees, even though I never receive that portion, it appears that I'm earning more revenue than I actually am. While I understand that operating expenses like the service fee will reduce my net profit, my income statement still shows higher gross revenue than I believe it should. How should I be accounting for the service fees to ensure my my income and tax reporting accurately reflect what I actually earn? Is there a better way for me to record these deductions in my finances for tax purposes?
Sure. So I think this is a very common problem because the service fee is quite high these days. Like, every credit card transaction, 3% is
Crazy. It's crazy high.
um, it is. I hear you. But generally, in these scenarios, what you should be recording is your gross revenue because technically that is your revenue. And the reason why it's important is, that should agree to your 5% is based on your gross revenue. So you need to make sure you're matching that as well, right? Irrespective of what you're getting in your bank, that's a different scenario. But what you've billed is what's important. That's how it has to be reported. It's not that you're over-reporting your revenue. That is your revenue. And then you're deducting all the expenses. Service fee is also one of the expenses that you can deduct. The reason it's also important to report the right revenue, the higher revenue, is because let's say in future, if you do plan to get any loans from bank, right? They are going to look at your income statements. They are going to look at your revenue that you've generated and reporting the right revenue, which would be higher revenue in your situation, would be the right way, because when they look at, the higher the revenue, the more chances of getting a better loan would also get in and tie in to that situation. The reconciliation, I agree, is going to be a little hard because what you get in your bank, you cannot directly code that as revenue. Now you have to break up to say that, okay, this is my gross, this is my taxes, and this is my service fee. And the taxes separate envelope goes to the government, right? You cannot use that. You don't use that number anywhere in your income statement. It's the income, the revenue that you report, and then the service fee will be taken as a deduction. Is that making sense?
Um, yeah.
Uh,
Yeah.
Let me give you a simple example. Let's say you have $100, right? And then $5 is the taxes, so 105 is what you should be getting from your client. Less, let's assume $3 for our example, is the service fee, and what you get is $102 in your bank. What you report is not the $102 as your revenue. You're going to report $100 as your gross as your revenue. $5 is GST that you would do your GST return and report those $5. And $2 is sorry, $3 is what you would show as a service fee expense. That is the right reporting, which is going to be hard with reconciling the 102 that you've got in your bank account. And you have to go through this process for each one. But unfortunately, you have to. There is no better way to do this.
So that is what I am like so that's kind of what I do. I do that. I show on the invoice exactly how much they pay to me, $100 for the class that they're paying me for,
Mhm.
and then I show the $5 of tax and then I show the $3 for service fee. But I just do the 108 as my income. I don't separate it any further. Now, then my idea is that when I go to file my taxes, I'm taking that large sum amount from all of 2024, the amount of services plus tax plus service fees, and I'm timesing that by 0.05 or whatever to figure out what the 5% of that is, and then pay that to the government? No, is that wrong?
I think it's wrong. Yeah. It's
Okay.
not 108, right? That your taxes are. It's 100 times 5%. That's $5.
Wait, say that again.
So your GST that you're collecting is on the tuition fees, the $100. That's what your GST you're collecting on. I think
Yes.
I lost you. I mean, I'm not sure what you're trying to do, but in the example that I told you, you're not collecting GST on the service fee. The service fee is just a fees that you are, right? That you're collecting, and then basically it's paid to the Stripe or Wix or whatever you're using as a software. So you've just collected that and you paid that. So you don't have to pay GST on that
Right.
per se, right?
So then how do I separate that in, so I need to separate the service fee, the tax, and
The revenue, yeah,
so what I send to the family, having the client, is
mhm,
all three of those breakdown. The breakdown of all three of those is what I send to them, but then what I have to account for is separate. What I have to do a breakdown, I have to actually have them separated for each three of them.
correct, yes.
Okay. I guess I don't know how to do that. Like within my software, I have to have three different columns. Like I have to, but then how can you know that they were connected?
Yeah, I think it might be best to do it via Excel because softwares are not capable enough to handle this.
Okay.
Like Wave will not be able to handle this
Yeah.
situation. Yeah.
Okay, because yeah, I haven't been because I try to keep them all together because then I can also go back and look at exactly which client paid what and like have that record. But if I separate the tax from the person who gave the tax, like the client who gave the tax, and that becomes
Yeah,
confusing. So you're recommending doing it on Excel instead.
correct.
Okay.
That might be the best way and easiest way for
Okay.
you to not complicate things, I guess.
Yeah. Well, I know, and I've been using, like I said, I've been using Wave for 10 years now, so that is quite a brutal change in my learning. I also don't use Excel at all, so that would be a whole new learning curve for me. Do you know of any free softwares that would, um, no?
Unfortunately not, no. I have to deal with so many clients that sell through Amazon and these. So it's even worse because now it's not even just Wix or kind of softwares that you're collecting the money from that's charging. There's Amazon, for example, has their own service fee that they're charging. So what you get is very different than what you've actually sold, and the taxes and the Stripe fee and the seller fees now. And there might be again, delivery charges and whatnot, which unfortunately a platform like Amazon, which is such a common platform that many people use on a day-to-day basis now to sell their products as an e-commerce platform, right? Yet there are no tools available to be able to break this down. Unfortunately, this is a manual exercise that we have to go through with our clients and situations like yours.
Wow, that's crazy. You'd think that somebody would be on this now. They'd be making a killing on just creating something
Mhm.
that would.
No, I believe QuickBooks did do some tie-ups with these softwares, Amazon, Shopify, like the common softwares, the e-commerce platforms, but yet they've not been able to resolve it to the dollar. I mean, you're still kind of, because think about it, if you're dealing with a lot of transactions, it's going to get even harder, but unfortunately, no.
So
Yep.
even if I go to Excel, like even like there's nothing that I can buy that would like support, it would still be manual.
Yeah.
Okay, so what if I decide, because I only just started having the option for clients to pay via credit card before they were just doing e-transfer, because that was like I was just starting out and that was easier. If I go back to that, can I stay with Wave? Or like is it that like I should still be sh having two columns for the tax, or is it just the fact that I've added the service fees that it's complicating things?
I think it's the service fee that's complicating. With Wave, it is capable to handle the GST. So if you code it right and it does calculate that piece for you and able to give you that.
Okay, so then what if I still don't like I take away the service fee, that's complicating it, but then I still just group um GST and income together and then at the end um do a
You
percent.
can't do that. You can't do that because if you're recording Wave for your sales, then you have to make sure that you code that, okay, this is GST sales, and it'll do the split automatically. So you cannot have a year-end entry. It's entry by entry that you need to make sure that you record it accordingly.
Why though? Why can't if they gave if I write that it was $105 and in the invoice.
You can do that formula, but then Wave software is capable to do it. So it might be easier for you to use that capability that's available to you.
But either is okay, but it's just like
Yeah,
there is an option to do the breakdown for you still.
correct.
Okay.
Yeah,
That I haven't been, I understand what you're saying, and I do understand that you can have the breakdown. I haven't done that, but I
yeah,
could start doing that. But what I am doing currently is having the tuition $100 and then $5, like a column that shows 100, a column that shows this is 5% of that, which is $5, and then showing the total that they paid me is $105, and then later I'll take that $5 and give it to the government.
right. But if you do it right in Wave, there is options and settings that you could use that capability. So you don't have to do that. It does that. The software does that for you already. So it'll show you, okay, 100 is towards the sales, 5 is towards taxes, and it'll also accumulate and tell you, okay, this is the amount of tax that you owe at the end of the year. Or any point of time, if you go, you can generate GST reports as well.
Right. Okay. Okay, maybe I should start doing that then.
Mhm.
Would you recommend going back and doing that or just from like 2025 onwards doing that?
I think starting 2025 should be good as well.
Okay. Those are kind of all of my questions.
I hope I was able to answer.
No, you were fantastic.
Mhm.
Yeah, no, this has been awesome.
Amazing. I'm very happy that you're taking full advantage of this, Queen. I genuinely think that this is like really great opportunity for you. So I'm happy that you're taking full advantage to it. I have one question that someone messaged me, and they're asking if QuickBooks as a software can be deducted as a business expense.
Yes, you can.
Perfect. Great to know. Did
Because at the
anyone
end of the
else?
day, you are using that software for your bookkeeping and record keeping, right? So you can deduct that expense as your business expense as well.
Perfect. Anyone else has anything they'd like to throw in there and ask? We've got a few minutes left.
I guess I have a
Now's
question.
your chance.
It's a general question. Do you have any or do you know of any like free resources that are available to learn more about tax or like anything surrounding that?
I think Copilot is amazing as well, that you ask a question and gives you the answer as well as the resources. But don't rely on it completely, I would say, because it may be wrong as well. But it's a great starting point to ask questions and get answers for.
Amazing. All right. If let me just quickly check about what we had submitted earlier, because I feel like we have touched on a little bit of everything, which is great.
Sorry, just one
Um,
other add-on there is even CRA's website is amazing as well. CRA has quite a bit of, extensive examples, explanations. And if you still don't have your answers, see, you can call CRA and ask them as well. They do help you out. So I really like, that's again another go-to that you can do the research sometimes, and even with cross-border issues, or sometimes if I'm not confident with what I've researched and I want a confirmation, I always call them. You have to call the right department to get the right answers. And they do help you out. I mean, it's a general question. I don't understand this, or, can you confirm this applies? So they are able to help out as well. And you could do that, Queen, for your GST quick method election. Let's say you tell them that you learned about it today, but you want to take advantage of it from last year. Is there any way you need to call them and ask them if there's any way they can apply it to the year, to the date before? Maybe they can help you out on how to do that then in that scenario.
Okay, yeah, I'll totally call them. I'll see.
Okay.
Is it
Yeah.
possible, please? Okay.
I thought I saw someone raise their hand.
I think seems like that is it from everyone. If anyone does have anything last minute, now's your chance, go for it. If not, then we can end things off here, which I think is a good spot. Ekta, is there anything else that you'd like to add or like to kind of close out with before we all go?
The only thing I would say is, I mean, as much as taxes look complicated, it may not seem as complicated as it is. But there are a lot of resources. As I said, CRA is one of a great touch points. Google Copilot, great starting point. Don't rely on it 100%. I think and there are many smaller CPA firms who can assist based on what your needs are. And that's my closing statement out there.
Awesome. Okay, thank you, Ekta, very, very much for joining all of us today and answering these questions. I feel like we really learned a lot from you, and I think not just on the personal aspect, but on so many different areas. So I think if anyone who either like has a small business, looking to start a small business, just trying to figure out where to start, I think everyone learned a little bit of something today, which is always what we want to have from it. So a big thank you to Ekta and a big thank you to everyone who showed up today, everyone who asked questions, everyone who took the time to listen today. That was amazing. Thank you all. And everyone is free to go. And I'll make sure to email you guys with Ekta's information. Make sure you guys can reach out to her if anything you want. Yeah, go for it.
The video, will this be shared? I would love to reference back to that.
Yes, thank you for reminding me. This will be on the Low Entropy YouTube. So once I've got it uploaded there for you, I'll send you guys an email with a link to it. You guys can have it for, again, clarifications of anything that you talked about or whatever it may be. So yeah, it'll be there for you and for everyone else to see. So thank you for everyone for joining, and I hope you
Thank you
all
so much,
have a good
Tori.
night.
Thank
Thank you.
Good night.
Bye. Good night.
Awesome.
We, did you stop?
Oh,
Let's.
yes.